Nice to meet you, Gilbert. I have a couple of questions, and I wondered if you share your views.
I'm very happy to. Thank you for the invitation.
Thank you. The first question was, of course, the area of risk management is getting a lot of attention these days, largely as a spillover of from the global financial crisis. And I hear a lot of discussion in Asia whether what's actually going on in the regulatory front really is an appropriate reaction to the Asian market and that type of thing, or whether Asia is being asked to comply now with a tightening regulatory environment that really it wasn't a part of a problem of, really.
Yeah, I mean, I think the interesting context is that Asia and Asian banks went through probably the similar set of circumstances as what's happening in Europe and North America 14 years ago during the Asia crisis. And I think many of the lessons learned, from that are being applied now in the North American and European context. And those lessons were learned the hard way here. In terms of sovereign debt levels, the deficits, how corporate customers behave. Understanding what is healthy balance sheet structure and healthy balance sheet management. Consumer debt levels. I think fairly broad spectrum. Those lessons were learned and for the most part avoided in this crisis in Asia. So in that context, I think that the Basel requirements, whilst there are good elements within the Basel III framework, it may not be as applicable for the Asian markets. I think a lot of it was predicated around investment banks, the funding capacity leverage of those banks. That's not an issue in Asia. I think the Asian banks, have the benefit and arguably the curse of having very good liquidity. The loan to deposit ratios are quite healthy, as well as high capitalization rates. Again, a product of what occurred. Also, the regulatory environment was much more rigorous, and there was active management by both the supervisory regulators as well as the central banks in managing the economies. So I think that there are lessons learned about what Asian banks and Asian regulators have done that arguably could have been used as a basis for I'll call it the European and North American context, as opposed to coming out with a very extensive framework which arguably will have negative impacts in Asia.
So do you think everything that needs to be done in the risk area basically has been addressed in the changing regulatory framework, or do you think are there still some types of risk you think that keep you up at night, basically, that haven't been really addressed under this more rules-oriented framework?
Well, again, Basel is really focused on two parts. Basel, up to Basel II, is really looking at risk-weighted assets and capital, making sure there's sufficient capital for the types of business. I think that Pillar 2 was a very good framework for banks and bankers to understand the implications of their particular operating model. Universal banks versus investment banks versus, call it more integrated financial services. So I think, Basel II had a lot of the ingredients. Liquidity was one area that arguably people took for granted. There was a certain level of complacency. So I think it's, that was a much needed and, helpful, application for banks to come out of the Basel. I think fundamentally though, those are only certain dimensions. I mean, risk management at one level is about behavior management, and there are many tools and levers that we use within an organization for that behavior management. Things that aren't being addressed per se are looking at say the funds transfer pricing, the FTP process, because funds transfer pricing, how you source deposits, how you reinvest those deposits, is not necessarily as broadly applied in the Asian context. I think it's quite well, well, it's reasonably well developed in say North America and Europe. I think there are, there are some areas that needed to be improved in the Asian context. I'm quite comfortable with what we've done in Singapore, and I think there are some other jurisdictions that have done well, but I think there are some that are still, lagging behind that could do better in that area. In terms of looking at risk-adjusted returns, that's also an area that I don't think, even though the framework is there, it really comes down to the discipline and what are the primary drivers, what are the various stakeholders really looking for. And if the stakeholders are the equity shareholders, they may be looking for different outcomes than what are the broad jaws for the firm. So from my perspective, there is still some work that needs to be done, but I'm generally comfortable that the basic premise of Basel is there. I think the application will have, like I said earlier, will have some negative connotations for implementation in Asia.
The area of funds transfer pricing, for instance, do you think that's a lack of interest in the process, or a lack of investment, or a systems issue, or?
No, I don't think it's so much the systems. I mean, I think the technology, both the methodologies as well as the basic systems are there, and the Basel III, in terms of giving preference to certain types of deposits, is already going to direct the businesses. You'll have to build infrastructure to be able to get there. I think one of the concerns is that building market share sometimes takes precedent over adequate funding, or the appropriate funding mix. And to me, that's really where we have to start directing the discussions at respective ALCOs in geography, is what kind of returns do we want to get from the businesses? Are we disciplined about it? Are mortgages at any price be acceptable, or is there a threshold where you say better walk from this business? I think some of those disciplines, you're looking at asset growth and top line revenue growth as being what many analysts focus on. I think that will have to change over time to look at what is the real franchise value, and how do you do you have low volatility in those earnings and that business model? Do you have and are willing to accept a greater volatility because the lack of discipline?
I'd say that the Basel III and Basel III plus reaction to the global financial crisis, that's largely been markets related and that type of thing, addressing some issues like leverage. They've also put in this macroprudential kind of buffer framework. Do you think that's adequate to capture credit risk issues and the pro-cyclicality and that type of thing? Because when you mentioned the Asian crisis of 1997, 1998, that largely was a credit crisis. But the reaction of Basel III has not been so much on the credit side, except for counterparty risk, perhaps.
Yeah, again, I think Basel II addressed a lot of the foundation requirements around credit. So I don't think there was a lot that had to be done that way. The current crisis was more around funding risks. So whether that was Northern Rock or other institutions in North America, Lehman's, Bear Stearns being examples of where the liquidity and funding capacity, for whatever reason, just dried up. So I think those were really the big drivers there. I think that's...
Yeah. Thank you very much.
Thank you.
Thank you.
Thank you.